problem is when, the United States is a very financialized economy, which, for example, means we have got very high wealth concentration, and a lot of that wealth, their income is tied to asset prices, either because of corporate compensation methods, or because capital gains taxes. All these different levers are the U.S. tax base is very tied to asset prices, more so than you see in Europe or Japan or other countries, China, for example. And so that makes it so that if they were to try austerity, like let's say they say, look, the entitlement system is unsustainable, the military spending is unsustainable, we're going to try to raise taxes or cut spending or do some sort of combination to pull the deficit down to 3% of GDP or something. The problem is that the way the U.S. economy is structured, you'd very likely get weaker asset prices, weaker corporate margins, just overall kind of weaker asset prices. Therefore, you'd get kind of a deceleration in U.S. tax receipts, and therefore the fiscal deficit would probably still be roughly as wide.
In a recent analysis by Lyn Alden, it suggested that the US economy may face challenges compared to other countries. With a highly financialized economy and significant public debt, austerity measures could lead to weaker asset prices and corporate margins, exacerbating fiscal deficits. This, coupled with potential inflationary pressures from structural money supply growth and energy market dynamics, may result in higher highs and higher lows of inflation, posing a considerable challenge for economic sustainability. As global trends in globalization accelerate, the US economy may find it increasingly difficult to maintain its current structure.
Right, I think that accelerates these trends. If deglobalization, around the margins happens, that makes it increasingly hard for the current system to kind of be structured the way it is. Basically, you'd expect all else being equal, higher inflation because you don't have those disinflationary offsets, and therefore you'd expect higher bond yields unless they're controlled in some way, and you'd basically get that repeated spiral that happens. You could get a bank failure, you could get disorderly treasury markets, you could get various things like that, and then they step in, they NQT, they do SLR adjustments, they do some sort of change, and that accelerates some of these things. I think things that can extend it would be things like major new oil discoveries and exploration. Right. So, for example, there's been some new oil fields lately that's been promising. If you have just overall, if you have just kind of more energy come to market than baseline expectations are, that can kind of push away this issue. You can get by with lower interest rates without necessarily having a inflation spike, and then therefore you can kind of keep an interest expense somewhat manageable for a period of time. The other kind of thing I encounter is that people say, well, here are some other examples of economies that have come down from the brink. They got up to roughly 100% debt to GDP. They were kind of right on the brink, and they started getting it down. But one thing that those don't generally have in common is that those are generally not financialized economies. And so there's kind of two components here. If you have a financialized economy and you don't have a lot of public debt, then you can gradually over time definancialize your economy. On the other hand, if you have a non-financialized economy, but you have a lot of public debt, there's ways to do austerity to lower that debt level without really tanking your economy. The problem is when the United States is a very financialized economy, which, for example, means we have got very high wealth concentration, and a lot of that wealth, their income is tied to asset prices, either because of corporate compensation methods, or because capital gains taxes. All these different levers are the U.S. tax base is very tied to asset prices, more so than you see in Europe or Japan or other countries, China, for example. And so that makes it so that if they were to try austerity, like let's say they say, look, the entitlement system is unsustainable, the military spending is unsustainable, we're going to try to raise taxes or cut spending or do some sort of combination to pull the deficit down to 3% of GDP or something. The problem is that the way the U.S. economy is structured, you'd very likely get weaker asset prices, weaker corporate margins, just overall kind of weaker asset prices. Therefore, you'd get kind of a deceleration in U.S. tax receipts, and therefore the fiscal deficit would probably still be roughly as wide. That's a very hard kind of tailspin to pull out of. And so I think that's why the number of moving parts there makes it so that the train is basically set, and then it just becomes a matter of what can accelerate it, what can slow it down, but there's not much that can stop it, is how I would describe it. And around the margins, you invest slightly differently depending on what's going to happen there. But I still think either way, it favors structural money supply growth. And then the question is, does that go mainly into asset prices or mainly into consumer prices or some combination of both? And that's largely going to depend on things like energy abundance, tech abundance, productivity increases. But that either way, investing is fairly similar in those environments. So I think we're going to have higher highs and higher lows of inflation than we had in the prior decade. That's how I would describe a secular inflation. Um, and kind of a major thing I've been pointing out is questions I got over the past couple years were, are they going to get inflation back down to 2%? And my answer has generally been, I don't know, but I don't think that's the right question. I think the right question is, what's going to happen with inflation the next time we have an upcycle in PMIs, for example, like manufacturing purchasing managers index, because I think that's the real test. You can get inflation down temporarily if you're willing to have a recession, if you're willing to disinflate enough, and that's kind of the pseudo cycle we've been on. It's obviously been offset by fiscal, as we've been talking about. So they've not gotten it down to 2%, but they have muted it significantly. We're starting to see early signs of PMI reacceleration, kind of rotation in what sectors are doing well. And so I think the big test is, if we get an upcycle in PMI, what does inflation do? My expectation is that inflation goes up or stays sticky when we get that next PMI rise. And so it's not a matter of, could they touch 2% sometime this decade? Sure. But the question is, can you sustain there and have like another cycle of growth while still sustaining there? And I think that's the much harder thing. And so, because I think this is going to be a more energy intensive cycle, I think we're going to be more linked to what happens with energy than we have been in say the prior 10 years or so. And so I think my expectations higher highs and higher lows compared to what we had in say the 2010s decade.
Continuing the discussion, the current outlook for oil-producing equities and energy-related assets appears promising, with valuations, balance sheets, and profitability aligning well with current oil prices. These assets are positioned within a favorable range. Despite uncertainties surrounding the timing, Alden anticipates a breakout from this range in the years ahead. Notably, the disruptive impact of shale oil on global energy markets seems to have receded, with supply and demand dynamics stabilizing. Furthermore, trends in Chinese demand and policy interventions suggest a constructive outlook for energy demand in the near term.
Think the upside breakout risk is higher than the downside breakout risk. And one reason I've liked to play the space by owning, say, oil producing equities and other energy related equities is that they've already been priced so that this oil level is good for a lot of them. Their valuations, their balance sheets, their profitability works pretty well at current prices. And so, rather than have a view kind of in the near term of what happens with oil prices, I've been preferring to focus on those equities. My expectation is that this is kind of the new range, but that in some point in the years ahead, I do think we'll break out of this range. Wouldn't That's something I'm less confident on the timing on than say fiscal dominance, but I do think that eventually we break out of this range. But in the meantime, I think we're range bound, and that's basically a disinflationary offset that doesn't exist anymore. So from 2015 to 2020, the rise of shale oil very much disrupted global energy markets because supply came online faster than demand, and a lot of that supply was unprofitable. So even the ones bringing it to market weren't really making money from it. At least their investors weren't. Um, and so as we kind of go forward, I do think that glut is behind us now. That doesn't mean that U.S. shale oil is going to necessarily go down quickly or even go down at all. But I think the delta, the rate of change over say a 5-year period is not going to be as significant as it was back then. And I think the global market now has this shale built into it. Um, and so I think there's fewer positive surprises to the upside in terms of supply. Over the past year and a half, China's demand has been kind of consolidating for a while because they were, they're going through that commercial real estate deleveraging. They had a lot of weak domestic indicators, even though their output was still good in terms of exports and things like that. There were early signs that they might be bottoming. They might be stabilizing and kind of going back up in terms of domestic consumption. And so it's not just the U.S. and the SPR that has held down oil. It's also China as also one of the biggest consumers. What's happening there, and I think that their politics have gotten to the point where supporting the equity market, supporting the real estate market, are probably starting to take a higher precedent than they were 12 months ago. And so my expectation is that both the U.S. and China probably are going to be relatively constructive for demand for energy over the next 12 months. But I don't necessarily expect fireworks, but it's just that's not something I try necessarily predict, other than I would be a buyer of dips, and I'm structurally pretty bullish on the energy space. A challenging thing is that the dollar index is so tied to the euro, um, that that particular currency pair weighs very heavily. So I am more interested on a currency by currency basis. Like I think some of the Latin American currencies are less weak than people are maybe accustomed to at the current time. So I think that the worst the dollar move is probably behind us, which should be somewhat beneficial for all these entities that have these dollar-based debts that are, maybe not in the most dire straits, but that are kind of teetering. I think a lot of them have gotten through the worst of it.
Today, we delved into Lyn Alden's insights on the economic landscape, highlighting the challenges and opportunities ahead. From the impact of globalization on inflation to the dynamics of financialized economies, Alden provides a nuanced perspective on the complex forces shaping our financial future. Remember to subscribe to our channel for more valuable analysis and hit the like button if you found this video informative. Don't forget to share your thoughts in the comments section below.